there's a vast, interconnected system operating behind every transaction, every salary, every loan, every investment, and every purchase made anywhere in the world, a system so large and so deeply integrated that most people experience its effects every day without ever seeing its full structure. And that system is what we call global finance, a network of institutions, markets, governments, currencies, and human decisions that together determine how money is created, how it moves, how it grows, and how it sometimes collapses. And before we move deeper into this journey, it is important to say clearly, in a calm and grounded way, that everything shared here is for educational purposes only and not financial advice, because understanding how global finance works is not about giving instructions. It is about revealing the structure behind the world economy so that decisions can be made with awareness. At the center of the global financial system lies a simple idea: money must move to create value. And for money to move effectively across countries, across industries, and across individuals, there must be systems that support trust, because without trust, transactions stop, and when transactions stop, economies slow down. And this is why financial systems are built not only on money itself, but on rules, institutions, and agreements that allow people and organizations to interact confidently, even when they are separated by distance, language, and legal systems. One of the first building blocks of global finance is the banking system. Because banks act as intermediaries, they receive deposits, they provide loans, they facilitate payments, and they connect individuals and businesses to the wider financial network. And when someone deposits money in a bank, that money does not sit idle. It becomes part of a larger pool that can be lent to others, invested, or used to support economic activity. And this process allows money to circulate rather than remain static. For example, imagine a small business owner depositing their earnings into a bank account. That money may then be used by the bank to provide a loan to another business that wants to expand. And when that second business grows, it hires workers, buys materials, and generates income. And this chain of activity shows how one deposit can indirectly support multiple layers of economic growth. And when this process happens across thousands of banks and millions of transactions, it creates a global flow of capital that connects economies. Another major component of global finance is central banks, which operate at the national level but influence global conditions because they control monetary policy, manage interest rates, regulate money supply, and act as lenders of last resort during financial crises. And their decisions affect not only their own countries, but also international flows of money, because investors, businesses, and governments respond to changes in interest rates and economic stability. For instance, when a central bank increases interest rates, it may attract foreign investment because investors seek higher returns, and this inflow strengthens the local currency and increases capital within the country, while a decrease in interest rates may encourage borrowing and spending locally but reduce foreign inflows. And these shifts influence how money moves globally. There is also the role of financial markets, where money is traded in the form of stocks, bonds, currencies, and derivatives, and these markets operate across borders, connecting investors and institutions worldwide, allowing capital to move quickly to where it is expected to generate returns. And this movement is driven by expectations, economic data, geopolitical events, and investor behavior. Consider a situation where a country shows strong economic growth, stable governance, and increasing business activity. Investors from around the world may decide to invest in that country's stock market or government bonds. And as they do so, money flows into that country, supporting businesses, increasing asset prices, and strengthening the currency, while the opposite may occur when confidence declines, causing money to flow out and creating economic pressure. Currencies themselves form another layer of the global financial system. because every international transaction requires exchange. And exchange rates determine the value of one currency relative to another. And these rates fluctuate based on supply and demand, trade balances, interest rates, and economic performance, and changes in currency values influence trade, investment, and purchasing power. For example, if a country's currency weakens, its exports may become more attractive to foreign buyers because they are cheaper, leading to increased sales and inflows of foreign money, while imports become more expensive, affecting local prices and consumption. And these shifts illustrate how currency movements shape economic outcomes. Trade is one of the most visible ways money flows across countries, because when goods and services are exchanged internationally, money moves in the opposite direction. And countries that export more than they import receive more money than they send out, while those that import more than they export experience the opposite. And this balance influences economic strength and currency stability. Imagine a country that exports agricultural products to several other nations. Every shipment represents not just goods moving out, but money coming in, supporting farmers, businesses, and government revenue, while a country that relies heavily on imports may send large amounts of money abroad, creating pressure on its currency and financial reserves. Another important element is foreign direct investment, where companies or governments invest directly in businesses or infrastructure in another country, building factories, funding projects, or establishing operations. And this type of investment brings capital, creates jobs, and transfers knowledge, influencing economic development. For example, when a technology company builds a manufacturing plant in another country, it brings money into that economy, pays workers, purchases materials, and contributes to local growth, while expecting to generate profits that may later flow back to the parent company, showing how investment creates both inflows and outflows over time. Remittances also play a significant role in global finance, representing money sent by individuals working abroad back to their home countries. And these flows support millions of families, providing income, improving living standards, and stimulating local economies. And in some countries, remittances form a major part of national income. Think about a worker living abroad who sends part of their salary back home every month. That money supports household expenses, education, healthcare, and small businesses. And when multiplied across millions of workers, it becomes a powerful economic force that connects countries through personal financial relationships. There is also the role of international financial institutions, such as development banks and global organizations, which provide funding, support, and guidance to countries, especially during economic challenges, helping to stabilize economies, fund infrastructure, and promote development. And their actions influence how money flows between nations. Global finance is also shaped by risk, because money tends to move towards stability and away from uncertainty. And during times of crisis, whether economic, political, or environmental, investors often shift their money to safer assets, such as strong currencies or stable economies. And this movement can create sudden changes in financial conditions across countries. At this point, if this message is helping you see how deeply connected the world is through money, how decisions in one place can influence outcomes in another, you can take a moment to subscribe to Careful Click channel. Give this video a like, share it with someone who wants to understand the economy better, leave your thoughts in the comments, and hit the bell notification so you do not miss future insights. As all these elements interact, it becomes clear that global finance is not a single system, but a network of systems, each influencing the other, banks supporting markets, markets responding to policy, policy reacting to economic conditions, and individuals participating through everyday actions, spending, saving, investing, and earning. And this interconnectedness means that understanding global finance is not only for economists or professionals, it is valuable for anyone who wants to make informed decisions. there is also a personal lesson within all of this. Because even though global finance operates at a large scale, individuals are part of the system. And by understanding how money flows, a person can better navigate opportunities, manage risks, and adapt to changes, whether it is choosing where to invest, understanding price changes, or recognizing how global events may affect local conditions. And in the end, the message becomes clear: global finance systems work by connecting people, businesses, and governments through the movement of money, supported by trust, regulated by institutions, influenced by policy, and driven by human behavior. And those who take time to understand these systems gain a clearer perspective on how the world operates economically. And as you continue forward, remember that every transaction, no matter how small, is part of a larger flow. And understanding that flow allows you to move with awareness rather than uncertainty. And thank you for watching Careful Click channel. If this message has added value to your understanding, subscribe, give a like, share this video, leave your comment, and hit the bell notification, because the next lesson may change how you see money forever.